So I wrote this article on Tuesday called The 200-Day Moving Average because it brings up exactly this point that Chris and I were just talking about, which is the biggest part. If you use a 200-day moving average, then it'll work. And over time, if you adhere to it over enough time, right, 10 years or 20 years, you will far outpace the return of the market because you don't spend as much time making up your losses. Now, but here's the problem. And so we're about to launch our pro version of our website here very soon, where you'll actually get access to all of our indicators and strategy and portfolios and all that, right? So I'm building some very special charts for that pro site. And what you find is that, yes, over time, there are occasions where an indicator will get you out of the market early. And you'll be convinced that you're missing out. You know why? Because the media is going to tell you you're missing out. You've got less exposure than you should, and the markets are going up and leaving you behind, and the media is telling you, oh, you got to be in, and so you jump back in right at the time that signal that was given to you comes into play, and you wind up losing a big chunk of money, or you get a false signal, and false signals happen. And the shorter your horizon, if you're doing a 50-day moving average, you're going to have a whole lot more trades going on in your portfolio with a 50-day moving average than you are with a 12-month moving average, right? Because you're speeding up the price changes and how often you get those signals. But it doesn't matter because more often than not, a sell signal, which, by the way, we have weekly sell signals on the market right now. This is a good example. We've got a short-term daily buy signal, long-term weekly sell signals. Now, that tells you that the price dynamics in the markets are downward, not upward. So despite the fact we're having this rally, we've got confirmed sell signals that suggest the market is still under pressure, which says you should have a little bit less exposure, a little bit more cash right now. That doesn't mean go 100% to cash because we're not market timers. But what we are risk managers. So there's going to be times, though, that the signals are just wrong. It happens because you have variabilities in the market, things that happen. As for instance, I was saying a second ago, in February of 2016, we had violated various levels of important support. We're on major sell signals across the board, and then Janet Yellen calls the QE kings, ECB and Bank of England, to start jamming the markets full of liquidity. And the markets turned around, went back up, and reversed the signals. Now, that happens, and that's okay. You just simply buy back in, and you keep going. The problem with most individuals is they get hung up in the psychological behavior of, well, I just sold out. I can't buy back in. I just sold that stock. I just sold ExxonMobil. Now it's going up. I can't buy back. I can't buy it back. Yes, you can. There's absolutely nothing wrong with that. That's part of investing. The difference between successful long-term investing doesn't mean you're going to be always successful right here in the short term. You could be 4 or 5 months underperforming the markets. A year, you can underperform the markets. But over the long term, any discipline that you follow with precision, you're going to win the investment game.